David's going to resume the presentation.
All right, thank you, Karl. Let's start in now on wages and inflation. So what's been happening is if you start before the pandemic, so February of 2020 is considered the last pre-pandemic month by most economists. So the economy hadn't started taking a hit yet. If you track from there, the wages have actually grown more than inflation, about 4% more. That means that you have about 4% on average. The average worker has about 4% more purchasing power than they had before the pandemic. You've heard about how the middle class is suffering and 2019 was so great and all this. And the fact is we have more purchasing power now in terms of hourly wages. And don't get hung up worrying about number of hours worked. Technically, you take the hourly wage times the number of hours worked. The number of hours worked fluctuates in a very narrow range. And to a certain extent, if people don't want to work, let's not punish anybody over that. So it's hourly wages is a great way of measuring the purchasing power of people. And throughout, you can see the blue line is always higher than the red line. There is at no point did the real wage fall during the Biden era if the starting point is pre-pandemic. It's always been higher than pre-pandemic. Now here is looking at it starting when Biden was inaugurated. And up until very recently, the inflation had exceeded wages. So the other flips the other way. And just recently, literally this month, the latest data, finally wages have exceeded cumulatively the inflation cumulatively. So we again, even if you measure from when Biden started, for the first time as of June, we're up. If this way of thinking about it causes you grief, let me show you this slide, which will put it in just dollars for you, so you can tell a story. And it's a somewhat complicated story because of something that happened in the pandemic. And there's a note in there, but let's kind of walk through it. So with February 2020, we're at $29 an hour. And when I say real, it's inflation adjusted. So we're talking apples to apples. These numbers are all comparable. 29 an hour. Then all of the million, as Karl pointed out, we had 22 million people lose their jobs. Disproportionately, a lot of those were lower wage workers. And so that leaves the higher wage workers in the job force in the average. And what happens? The average spiked. And so that's that large gain you see there where the gray shading is. The gray shading is the recession. You saw this huge spike. It wasn't because people suddenly got raises. It was because they took a lot of low-wage jobs out of the measure. So the economists call this a composition effect. The composition of people that were being measured changed. And so it took a while for that to work itself out. You can see the numbers started to drop and it plateaued for a while. And then inflation really kicked in. And so the real wage fell. It hit that bottom somewhere in 2022. And then since then, it's been climbing. And so now you can see it's at about $30, $30.05 an hour in current 2024 dollars. And that's slightly higher than where it was when Biden took over. And it's about 4% or about $1 an hour, a little over $1.05 an hour higher than before the pandemic. And so when you're analyzing real wages, you can say Biden has a higher wage or higher real wage, about $1 an hour higher than 2019 or 2020, February 2020. You can see from the chart that February of 2020 was higher than 2019. So we're giving Trump a little boost here. 2019 would be a lower number, is a lower number. In January of 2021, that 30.01 an hour, that plateau in 2021 was the year with, on average, the highest real wages ever. So 2021, even though you got the spike in 2020, on average, 2021 was the highest year ever. And that's Biden's first year, right? And so real wages came down a little bit from there in 2022 and part of 20 and most of 2023. And then now they're back up above where Biden started. So if you want to, make Biden look bad, you say real wages have not regained their pandemic peak. They haven't regained that giant spike level. That spike is baloney. It's not a real number. It was just because 22 million people, mostly low wage workers, lost their job. So the more relevant comparison is against where we were before the pandemic, and we're clearly well better than that now. So I've seen some charts from Trump where he talks about the real wages grew faster under Trump than Biden. That is true. He's not lying. But what matters is, I mean, I want the extra dollar an hour, which for a worker is $1,800 a year, approximately, for a full-time worker. So, that's where we are. And so this story gets distorted a lot of real wages fell under Biden and he's a bad president because workers are suffering. And it's like, these wages are incredibly high. They're higher than 2019. And at no point, if you look at that red line, at no point is it lower than February of 2020. We've always been better off, even with inflation, because wages have grown so much. And so that media narrative of middle class is suffering under Biden, they may be, but it's not because of real wages. Real wages are higher than they were in 2019 when everybody thought the economy was the greatest ever. And Trump was not afraid to tell everybody it was the greatest economy ever. He said it a lot starting in 2018. The economy was even better in 2019. Pandemic hit in early 2020. And even then, wages have really grown faster, and we're looking good on this measure. But it's used a lot to tell, very misleading stories, and so you got to be careful with it.
So, David, can you go back to that for a second?
Sure.
So where does the comparison come from? I see June 2024 is $30.05 an hour, but that peak because people were losing their job. Does that go back to that January 2019 area where it's around $28 an hour, or are you pointing out February at $29 an hour?
Sure. Okay, so the spike is happening in early 2020, right? So the people lost the jobs. What was it, Karl? March to April were the two big months. March small, April big.
Well, the way it works is February to April, but yeah.
February to April of 2020, you've got 22 million people losing their jobs, and that's where this big spike is. So can you guys see my arrow on here?
Yep.
Okay, so going into the pandemic, we're at 29 an hour. We got this giant spike up into what is that, 30.75 an hour, probably somewhere around there. And then it falls because people start coming back in the workforce quickly, kind of bumps sideways, drops a little bit when the inflation really starts going. And then now it's been climbing as inflation has fallen, but wages have continued growing. And now we're at $30.05 an hour, about $1.06 or 3.6% above February. So if you're a Republican, you're going to argue, look at this peak. That's how awesome Trump was. And then now we're down here under Biden. If you want to be fair about it, you say we're better than pre-pandemic. The 30.05 is way above 29. And if you want to give Biden some kudos, you can say 2021 on average was the highest year ever. And in fact, if you take from January 2021 all the way to the end for his presidency, and I don't know if I have that slide next or not. I may have taken it out. I think I took it out. Yeah. We showed it last month. Biden, kind of like the unemployment rate is the lowest of any president under Biden. The real wages are the highest of any president under Biden. So this plateau here is extremely high historically. You can see we've got this chart going back to 2017. These numbers were all solid, plenty good. Biden's up here on this plateau. So we sort of had the pre-pandemic, and now we're on a new plateau that's about $1 an hour higher. Does that help, Bill? Does that answer your question?
Yes, it does. Thank you.
It's a complicated story, and the media has really distorted it just because of that spike. This baloney number right here has thrown off the analysis. It's better if you almost think about, look at the trend, and we're pretty much, it's a little bit below probably where the trend line would be, but not far, if you ignore all this drama in here.
So do we simply say that Trump managed to reach that peak by killing off enough low-wage workers?
That's one way to look at it. That's right. So yeah, this is just not a number that's relevant. And so I use pre-pandemic. A lot of our analysis is pre-pandemic to current, because there are so many distortions in that 2020 to 21 timeframe. Now here is just smoothed out a little bit. So these are annual averages. So same chart as the prior page, only showing each point on the line is the annual, each of the bends, each of these little corners is the annual average. 2021 is the record. It's the highest, slightly above 2020. So Biden's got the highest year ever. And 2024 literally is 2 cents below 2021 right now, year to date. So you've got Biden with the highest real wages, more purchasing power than ever. Going back to that, this data goes all the way back to 1964. And nobody in the news really knows this because all they've been saying is real wages are down under Biden. Washington Post, New York Times, that's all they've been saying for the last 3 years. And that's really, they're lying to us, to be honest. That's a really bad way to describe what's happening. It's just analytically irresponsible to explain it that way. So now when you break it down into detail, who is getting the benefits of these wages? Like which groups are growing the fastest or the slowest? And Aaron, is it Aaron? He's got a longer first name. Dubé is the economist I follow. When you look down here, Dubé, Autor is a famous economist that does labor economics. But they did this study. It's linked, you got the citation here. The 10th percentile groups, the lowest wage workers, have had the fastest wage gains. These are real wage gains under Biden. The 50th percentile, that's the median, and the 90th percentile, the rich people, pretty flat. 50th percentile also fairly flat, but the 10th percentile way above. So this has been good for the lower wage workers. And one way to think about it is they went from doing minimum wage jobs at McDonald's to getting 15 or 20 an hour doing warehouse jobs at Amazon. That's the story writ large. Now, when you look at age, under 25, also the fastest wage gains in under 25. In fact, the younger, the faster. As you get older, the gains come down. The real wage gains come down. So young people that have decided they're fed up with Biden because their wages are low or whatever, they're just wrong. The wages have gone up more for them than anybody else. And when you look at the racial breakdown, actually, Black or African American had the fastest wage gains. Hispanic second, whites third. Whites actually down slightly from before the pandemic.
Again, this is in aggregate, not an individual
Right.
view of the world.
That's right. This may not reflect, some of the communities in Chicago. This is an overall national average. All right. Next slide. CBO did a study that said that essentially you've got more purchasing power in 2023 than 2019. And it's complicated how they describe it. But what they said is if you're buying a basket of goods, if you're buying the same stuff, you can do it with a smaller percent of your income in 2023. It would have taken a bigger chunk of your income to do it in 2019. You can do it with a smaller chunk of your money in 2023. CBO is the most credible source that you've got for analysis. They advise the Congress, both parties. They are currently, I believe, run by a Republican, and they continue to do great, unbiased work. And so this is about as good a source as you're going to get to summarize what I've been talking about, which is you've got more purchasing power in 2023 than we had in 2019 before the pandemic. Karl had a good question for me. He wanted me to look into it. I need to do more research on this, but it was a couple of things to think about here. The inflation statistics don't do a good job of reflecting some important costs that people have. One of them would be what you pay in interest on your credit cards or your mortgages. So let's dig a little bit into that. I don't have a great answer yet. I'm going to keep wrestling with this, but let's talk about what I did find a little bit. On the mortgages, the graph that's on the upper right part of the page, a lot of people have 30-year mortgages, and they got into those 30-year mortgages before the interest rates began to rise. And so what they're showing here, the two lines are the gray line, the gray thinner line is the average rate on the existing mortgages. And then the darker line is the rate on new loans. So a new loan might cost you about 7% to get, but on average, people are in this 4% range. That's what the typical person has on their mortgage, which is not financially crippling. It's fairly low historically, and not an undue burden on people. Plus, one thing about mortgages, keep this in mind, is your payment is fixed, but your wages, in theory, have been going up, and so you're able to make that mortgage as a smaller share of your income. than it was before. So now if you're a new homeowner, or if you're and had to pay that 7%, or if you want to buy a home, you may not want to do that. Also, if you're thinking about selling your home and you realize your 3% mortgage might become 7%, you may be locked in, or that's the saying, locked in by the high mortgage rate that you would face if you sold or if you bought. And so that's why, if you were to look in at a lot of the housing statistics, show that there isn't as much activity, sales in the housing market, as you would normally see. But keep that in mind, is that because that average fixed mortgage rate is still pretty low, about 4%, this is not something that's going to be doing a lot of damage to consumers right now, unless you're one of those few that bought, and has a 7% mortgage. And you can see historically, if you go back far enough to even the year 2000, mortgage rates were as high as they are now. This incredibly low interest rate thing is a more recent phenomenon, more or less post 2008. Post the Great Recession is when we had these near zero interest rates for a long time. The rest of our history, you paid 5, 7, 10% for mortgages. And when you look at credit cards, there's about $1 trillion in credit card debt out there, and the interest rates have gone up about 7%, from about 16% before the pandemic to 23% lately. And so that's a very high interest rate on a credit card. And that's about $70 billion that's going from consumers that are carrying credit card balances. And that hurts, no doubt. That's doing some damage. That isn't captured directly in the inflation statistics. So there's an expense here that's if you looked at just this, you might say, well, that's, the inflation rate that people are talking about may be a little bit low. And I'll talk about an offset to that in a minute. But it's $1 trillion credit card debt, $70 billion that's out there. Something important to think about, though, is that who spends is very much skewed to how much income is made, And so the bottom 40% of households spend like 22% of the total. And so it's not going to, the day, if there's $70 billion more in credit card debt that's out there, that not necessarily is going to slow the economy overall very much. Further, credit card delinquency is going up, but it's still historically low. It was over 4% from like 1996 to 2007. So 10 years there, it was over 4, and now, like I said, it's like 3-ish. So not a particularly high delinquency rate, although it's going up. Now, corporations that are paying interest on bonds that they are issuing to the world are passing those costs along to people. So that's an example of an interest cost that is probably captured in inflation. I mentioned the mortgages, probably not a big deal. Credit card probably is affecting consumers. But again, those bottom end of the consumers are, the bottom 40% is only 22% of the total. This is a picture of that. The 80th to 100th percentile, so the people that make the most money, that top 20% does 40% of the spending, and it's kind of reversed down here. The bottom 40 does about 22% of the spending. And so if this group is being slowed by higher credit card interest rates, it's still not a huge chunk of the spending compared to what these guys are doing. And most likely this group can handle higher credit card interest rates, either because they just pay off their balance every month, or because they have so much income that it isn't as big a deal. That interest is not as big a deal. So, but I don't have a good measure of, would inflation be, an extra 0.5 point or less if you threw in the interest. I don't know that. I've got to look into that some more, but just wanted to give you some data points to think about, is that it should not materially change the interest calculations that we're seeing. When you look at net worth, we've talked about net worth separately in some detail by group. We get that data every quarter from the Fed, so we always know how wealthy people are, and it's easy enough to adjust that for inflation. But if you look at net worth, the bottom 50% group, the 50th to 90th group, both of those have far exceeded inflation, along with wages. And I'm doing, the numbers are slightly different from what you've seen because I'm using the quarters, the fourth quarter of 2019, because this data for net worth is quarterly. So I'm doing apples to apples. Quarterly, first quarter 2024. So you can see the net worth of even the bottom 50% group has gone up tremendously during that time. And the 50th to 90th group also up quite a bit. There's a slide at the end where I'll put that in dollars for you. But still, just when you talk about how much consumers are suffering, take it with a grain of salt. Yeah, there are some people that are suffering that didn't get the wage hikes, that are paying a lot more in rent. But when you look at the aggregates, it's not the story for the average person. The ACA has been incredibly successful. It had a great 2024, 21 million people on the exchanges versus, only 8 million when the law really went into full effect. Even though it passed, I think 2010 or 11, it really went into full effect in 2014, and we've had some solid growth in there since then. The pandemic, there were measures taken during the pandemic to make it easier to get this insurance, made more people eligible. And when you look at the percent and the number of people that are uninsured, both are at record lows under Biden now. They had been falling throughout the Biden era, and then they crept up a little bit. Trump did a lot to sabotage the ACA, and so it went up for a while. Then when the pandemic hit, he did enact measures to expand access to the ACA. So in 2020, we got that was part of the CARES Act, and that was extended under Biden. And so you've seen these numbers have gotten to be the best they've been. I've only got this back to 2010. I've got data back to the 90s. This is still better than even going back into the 90s. To kind of summarize, if you look at the unemployment rate along the bottom from 3% up to 8%, and you look at the real wages from about $23 to $31, because all the presidents fall into that range when you average their administrations, you want to be in the upper left corner, right? You want the highest wage and the lowest unemployment rates. You want to be up here. And who's up there? Biden. Biden has the best combination of unemployment rate and real wages of any president. Trump is not far behind him. And in terms of unemployment rate, Biden just passed LBJ a couple months ago. This chart is a month out of date. Biden would be scooting up very slightly to the left. He would be better than this. He might be close to that. I guess he's over 30. Now, he's not quite $30 on average yet. So he'd be a little bit closer to that 30 line and that 4% average. He's really close now. So people don't know this. They don't understand that these are two really critical measures for how the economy is doing for individuals. And Biden is the best of any president on average. Any questions, any comments in the chat on that? I can't see the chat when I'm in my, well, I guess I can. There we go. Any questions or comments here? Ask or forever hold your peace until we get to the next section. All right.
Yeah,
Dave,
I've got something.
Yeah, sure.
Comments. First, when you were talking about the wages being $30.05, that's a little northward of $60,000. And in Ohio, the median income in Ohio is around $38,000. Now, it depends on, if you look on their website, the state's website, they said that the per capita is $57,700, which means if you can find me a couple 2-year-olds, I'll be happy to adopt. But U.S. News and World Report had a thing, their 2023 ranking, and they gave the state of Ohio having a median income of $38,000. So in Toledo, according to the mayor's last budget report, it was a little bit north of $41,000. So,
Okay, yeah.
So Toledo's got 260,000 people in it. So you're talking that you've got at least 130 people living either at the median or below the median.
Right.
So
right.
I think this is the disconnect when you tell people, and like Miss Pennick made a good point, is that they're not seeing it, and especially in prices. Like, for example, it just came out in Ohio that rent has gone up 18% in 2 years, and this is, so you add that on top of living below the $30.05 an hour wage, and there's your disconnect. And what do we do about that? It beats the hell out of me.
Yeah, I mean, it's not easy. I mean, there are always going to be people that are below. I mean, half the people are below the median, right? I mean, that's the rule. And so this chart here is using the production and non-supervisory workers. So it's the bottom 80% of the non-salary workers. So this number is not distorted by the high wage earning, salary people. It's the It's about the bottom 80% of private sector workers. I should clarify what I said. It's the non-salary workers, which are 80%, the bottom 80% of the workers in the private sector. So you're right. I can't dispute what you said, but I would also say that the numbers are better. Meaning, if you went back to 2020 or 2019, according to this, they were worse. We're better off now. Meaning, those numbers should be theoretically lower in 2019 than they are now that you just cited. But I haven't seen that. I don't know. I'm not looking at it. But I will always say there are going to be pockets of people that are not keeping up with the average. That's the nature of it, or median. And they may be upset about this, but if somebody says the economy sucks, it may suck for them, but it's not sucking on average. And that's something that's important to point out, because people will say they think the economy sucks for everyone because it might suck for them, and that isn't the truth. They have fallen behind somehow. One thing that was very interesting in the wage data is if you stayed with the same employer, a lot of people, they fell behind. The people that got the big wages are the ones that left their employer. Now, some employers were good about keeping up and giving people the right wages, but a lot of companies didn't do that. You had to leave your job to get the big raise. So that's part of it, is part of why that happened. But I can't dispute it. There's no cure for what you said, Glenn. It's true. There are people that are left behind. And what we do, though, we're only talking about wages and things like the child tax credit, or the things that Biden was talking about in the BBB, the more expansive BBB that passed the House, Build Back Better. So things like elder care, paid leave, daycare for kids, tuition paid for. These are things that the Democrats are offering if you elect enough Democrats that Republicans are not. You may need a lot of Democrats to get these things passed. You may need a supermajority in the Senate. You may need a filibuster-proof majority, but that's a case that a president needs to make. And that's one of the challenges with Biden. He struggles with that, is he needs to be able to, in front of people all the time, saying, if you give me what I need, I will deliver this value to you. And he is having trouble with that. He struggles with that. And, I don't want to get into that we can do that at the end of the session, where we sort of turn off the recorder and talk about what we really think. But I mean, this is where it's just, there are messages that can be delivered that aren't about wages, about what Democrats can do for people.
Thanks.
Keep bringing that up. That adds a dose of reality. And, listening to me drone on endlessly, as I can understand why people would be struggling with that. We got through the ACA. All right, some other economic indicators. We'll go through this a little faster, because I think the most important story we've kind of told, and I do want to have time for the platform piece. The Fed has updated. We said that we shared this last month. The Fed updated their forecast in June. It's a solid forecast, slowing economy, but still good. Not a recession in their forecast, as far as we can tell, although it may get close. So we'll see. Bear in mind that a recession with 4% unemployment ain't all that bad. A recession with 10% unemployment, that's bad. All a recession says is you've come off a peak. And that it's kind of tough to maintain a 3.5% unemployment peak. We talked about the SOM rule a little earlier. That's what we're seeing. It doesn't mean the economy is bad if turns out we're in a little bit of a recession right now. Usually the National Bureau of Economic Research, NBER, will retroactively identify a recession. They will say maybe a year from now, they might say we were in a recession in June of 2024. They don't do it right away. So, but this is very solid here. And what they changed in their last forecast, though, was they did increase the interest rates that they expect to have, because the economy was running a little better than they thought. And we'll see. But it's a good forecast. We actually had prices fall versus the prior month. So in theory, the price of the basket of goods that the CPI analyzes, the Bureau of Labor Statistics analyzes, the CPI, was down about 0.1% in June versus May. And then May was actually flat. So prices have not gone up since April. They've come down a little bit, actually. When you go and look at versus a year ago, prices are up about 3% now. The core is a little higher. Core excludes food and energy. Much better than where we were, 2 years ago when we peaked at 9. So this is very good news. Notice both of those, or the blue line's moving kind of sideways and a little bit down lately. The red line has been consistently coming down. So why is that happening? So, when you look in, you break it down into the pieces, all the data, all the columns from December to June are by month. So versus the month before. So the June column is comparing versus May. And then over here on the right, this one is just versus the year earlier. So you've got the 12-month comparison. But when you look at these, the numbers that I just shared on the prior slide for the month, the -1 and the +1, are in purple. Green tells a good story. Food at home, meaning grocery prices, have not moved really in the last since February. And I think they're about the same as they were a year ago. Food away from home, though, restaurants are up because people are going out and eating. But it's a sign of prosperity to some extent that they feel comfortable doing that. Gasoline prices are down. And then down here, this was the good news in the last report, the big piece of news. Shelter, which is rent, has sort of always been, 0.4% the last 4 months there. Was, if you multiply that by 12, that's 0.4, 4 times 12, almost 5% annualized. And that's about what you see here. We actually had it only go up 0.2 in June. So that was a welcome relief. And if we can keep seeing that, or if shelter actually goes negative, you're going to see, you could see more months of negative inflation, deflation, which would be great. That would get us back to that 2% target. So we'll see if that happens. This is, each of those rows that I just showed you is not weighted equally. This is what people spend on average. So housing is about a third. Transportation includes gas and cars, food, insurance, and pensions. And pensions is kind of funny. I guess that's what you're putting away in your pension. Healthcare, and then a few other little buckets. But this tells you why housing is weighted so heavily in the CPI index. And when that number starts to go a good way, when that inflation falls, that's great news. And that really brings that CPI inflation down. And that's what happened in the last period. It's not down, it's just not going up as fast. That 0.2 versus 0.4 was a welcome relief, and that's because of this big blue chunk of the pie here. Investor inflation expectations, it's derived from bonds that some are inflation protected, some are not. Only about 2.2% expected over the next 5 and 10-year window, which is great news. And so the Fed funds rate has been at 5.3% for a while. We see that investor inflation expectations has been moving sideways. It fluctuates, but it's been moving sideways for a couple of years. We'll see if the Fed can get that down under 2%. That's their target. I mentioned NBER before. We also talked about the SOM rule, meaning if the SOM rule triggers, that's a potential indicator of recession. Here are 6 measures that NBER uses to determine if we're in a recession. And all of them are showing growth relative to May of 2023. So about a year ago, a little over, all of them are above that level. Now, all of them are not moving up that entire time. Like you can see the orange line moving sideways and sort of just barely made it above the starting point. So you could eyeball this, try to figure out, all right, are each of these measures going up, down, and you can cut the window to a shorter window. But just using the last year, this would say we're growing. We're not facing we're not facing a recession. You'll hear a lot about Trump's policies talking about tariffs. This is an excerpt from a CBO report from a while ago. What tariffs are really bad news for us for the most part. Tariffs raise prices of imports. That's the purpose. That's why they put them on, to try to discourage imports and try to keep as many jobs here as you can. The problem is when people are spending more on the imports, they don't have money to spend on stuff domestically, and so you wind up not getting a real benefits. Kind of like unions, you can protect a particular industry, but on average, overall, you might not come out ahead. Depends. Tariffs, the general science on tariffs is that they're bad. So CBO said the average family about $1,300 when Trump did it before. It's like a tax. Think of a tariff as a tax. When you hear the word tariff, just go tax. It also had other detrimental effects on the economy. The slower GDP growth, the lower, about a 0.5% increase in prices. It wasn't real obvious because we didn't have much other inflation. But if we were to suddenly jack up tariffs, as Trump is proposing globally, 10% on everybody, 60% on China, you would see significant impacts on households. And here's an estimate from the Council of Economic Advisors. This is the group, they work for Biden, but they also they're very fair. Like, I haven't seen this group coming up with a lot of crazy, rosy statistics to make Biden look better. They play it straight. And they're saying, if you do this, you're looking at particularly poor people that buy more of their imports. They go to Walmart and they buy toothpaste and other things that are being made in China, clothing. All that's going to be more expensive. And you can't just replace China's manufacturing overnight by going to some other country. It's going to take a while for other countries to pick up. And for domestic producers to produce more, perhaps. And so you're going to see pain for a while, and across all the groups are going to suffer from a tariff. Steve Ratner also, we've shared this before, violent crime is down. So this is talking about murder, rape, assault with a weapon, other things. This is the rate per 100,000 people. So in 2020, it was almost 400 per 100,000 people were a victim of a crime in a year. It's down to 294. So it's down by 100. It's down by 25%, 26%. Fantastic. You don't hear that on Fox News very much, that crime and violent crime is way down, but it is. What they usually do is they will say crime in a particular Democrat-run city is up or down. But even lately, the city statistics have been showing a big decline. And the reasons aren't all clear. I don't have an answer for you on all the reasons for that, but it's happening. Immigrants are less likely to commit crimes. So part of why perhaps that number is falling is because we've had a big influx of immigrants over the past few years, and they have a lower crime rate because they're trying to stay out of trouble. The most of them, they're just trying to maintain a low profile. They're not messing around. They also may not know very many people and aren't joining gangs and other things. So don't assume that because we've got an immigration wave that we have a crime wave. In fact, we have the opposite. The crime rates are down. Any questions on some of those extra statistics, random statistics, before we go to our last section, which is we're going to be building out this section over the next couple of months, because as we get toward the election, we're going to be analyzing the heck out of people's platforms. So I showed you one slide just a second ago on the tariffs. I could have theoretically put it into this last section, the platform analysis. I will in the future. But this section goes into now let's look at the proposals and kind of quantifying the impact on the budget and on the economy. As you might expect, the Biden policies are not only are they a lot more popular, but they also have much better economic effects than the Trump policies. This is a tweet from the Biden-Harris headquarters that they talk about what they want to do. And not all these are economic. Restore Roe versus Wade, so the national abortion protection, Voting Rights Act, expand Social Security and Medicare, get rid of medical debt, raise the minimum wage. I'm not sure what the PRO Act is. I think that's the union one. The sort of overriding these right to work acts, sort of make it easier to join unions, banning assault weapons. We already lead the world in terms of our energy production. So when you hear Republicans say Biden was destroying the U.S. energy production or made us less independent, that's not true. Energy production, crude oil production, for example, was higher under Biden last year than it was under, or lately, the last 6 months or so, higher than it was under more than about 9 months higher than it was under Trump. Child tax credit, the insulin cap. I think we have the insulin cap for Medicare. We want to try to expand that to everybody. Build more housing, invest in child care and elder care, which is the BBB. Again, which had passed the House. I just mentioned we'll be drilling into some of these, but what Biden mentioned in the debate is right now people don't pay taxes into Social Security on their income above $170,000, nor do you get more benefits. If you don't change the benefits, but you remove that cap, so you start taxing income above $170,000, you actually start funding a big chunk of that gap in Social Security. Social Security has in today's dollars, let's call it $300 billion gap a year over the next 75 years. That would cover removing the cap, taxing all that income above $170,000, but not increasing benefits, would cover about 70% of that. What Biden is proposing here, over $400,000, would be more like 50 or 60% of it. He also wants to add 1% to the tax rate that people that are millionaires pay. So if you're paying 6.5% as a millionaire, you'll be paying 7.5%. And he said he'll raise it more than that if necessary to cover Social Security and perhaps expand it. Trump has said he won't cut Social Security benefits, but he hasn't proposed any tax increases. So you can't, if you're not going to cut the benefits, you got to raise the taxes. There's no other math unless you just choose to fund it by the deficits. You just don't bother raising taxes. You just borrow more money and put it in Social Security. That is a possibility. And then other proposals, the child care and elder care. Biden has proposed raising taxes, income taxes on people over 400,000 to fund some of that. It's unclear if Trump has any plans to take on either of those two things. The Republican platform, I apologize that it's very small. There's a lot of seal the border, stop the migrant invasion. There's all this hyperbole in here. There isn't a lot of stuff that I think most progressives or Democrats would really want. Carry out the largest deportation operation in American history. I don't want to get thrown into that camp along with the immigrants and shipped out of the country. They better. I would not want the U.S. military creating camps. Let's call them what they are, or perhaps what they are, concentration camp. Putting people in there and shipping them. Probably a better analogy is what we did with the Japanese in World War II. Put them in camps and then move them. So all of these things are either, not going to happen, alternative reality, or they're just cruel in some cases. There are some stuff in here like tax cuts for workers, no tax on tips. I think that's a great idea. I mean, when Trump said it, Biden should have said that's a great idea. I would agree. Let's do it. He just let that go. And I think some workers are going to be influenced by that. I think that's a great idea. So we'll quantify that for you in upcoming meetings as people research this and get the dollars out there. Lots of think tanks are working on that now. We'll be getting more data, but you're going to see. You guys can read it. I don't want to go through all of it, but it's here for you. There's a lot of stuff we don't want in there. When you look at the Washington Post did an interesting article. It's down here at the bottom, and then YouGov is the one that did the study. You can see this for free if you can't see the WAPO article. I highly recommend looking at this. When you look at Biden's, I think they used 26 policies, 28 policies. Biden's were almost always popular, above 50% popularity. Each one of these dots is one of those policies, whereas Trump's were almost always underwater. They were below 50%. So when you talk about populism, Trump is a populist. Don't ever give him that high ground. Biden's policies are much more popular. He's the populist, if you want to look at it that way. But this was a great. YouGov is a very highly regarded polling group. They did that study. You can see it yourself. Biden's stuff is more popular than Trump's for good reason. This is the New York Times has also created a page comparing the candidates on each of the issues. So if you have a subscription, you can see this. One of the areas is democracy. And so this basically says, Biden is a defender of democracy, and Trump is the only president who has refused to accept his loss. He tried to overturn the election. He used terms like vermin. He's demonizing opponents like migrants, dehumanizing swaths of society in language that echoes Hitler and other authoritarian leaders. I almost fell off my chair when I saw this from the New York Times, because they've been doing a lot of Trump's heavy lifting for him lately. Then they do this. So good for them. They just lay it out there in very stark terms. There is no comparison between these two guys on this subject. But you can see this for lots of other issues, and we'll share this for some of the economic stuff coming up. Finally, there's some talking points here that are handy on Biden. If you want to put some stuff into a letter for a congressman or writing the local papers, you can grab some of these and just convert them a little bit. Like I was putting some of this in first person Biden speak. Like I've got the record for highest hourly worker wages of any president. Biden has the record for highest hourly. You can adjust these slightly, but there's some good ideas for you here to use. Here's a comparison of 2023 versus 2019. We share this every month. It's full year averages showing that 2023 was way better than 2019 on about any measure you can think of. You can find measures for Trump that are a little better, but there aren't very many, and they're very close. They're very close between the two candidates if you do. But the huge gains in net worth are on here. So you see the bottom 50%, 33%, 33,000 or almost 34,000 net worth of the bottom 50% household on average is now 55,000, and that is adjusted for inflation. Same thing with the 50th to 90th group, way up, almost $150,000 richer in that group. And part of that is the stock market, part of it is housing. So you can see that the net worth, the wealth of the United States peaked in 2022, adjusted for inflation, and we're still way higher than 2023. Meaning if I was comparing 2022 versus 2019, I'd have an even higher number in here for those two people, for those two groups. This is the bill chart. It's same information, only used as, if you like bars, shows them as bars. And then here's a fast facts that has a list of some other sort of the talking points sort of crammed into short paragraphs. And this is a really easy format to share on Twitter. It just happens to fit in the box that you put on Twitter very easily. You can cut and paste it right out of the presentation and put it in there. So I think, is that the last of it? We have a page that has some links that you can use. If you've got the presentation, you can actually click on these or just cut and paste them into a web browser and it'll take you there. But you'll find that, you know, the economy does way better under Democrats. It's not really close. There's an article in the New York Times on it. There's a Wikipedia article on it. I've got the thread that I use. If you know Twitter, my pinned thread or my posted is a bunch of slides on that subject, so you can always get at it. There are Wikipedia articles with this information that I keep updated out there. So there's lots of good data for you to use, and these are some links for it. And that's it. I think that's the end. Oh, let me show you one more. This was not in the stuff that Karl and I looked at. This is an idea I was tinkering with. When you're trying to understand how the economy is doing, one way of thinking about it is, you know, one of the challenges with the unemployment rate is it's defined negatively, like it's the number of unemployed, right? It's unemployment. This is the employed ratio. So I just flipped it, 100 minus the unemployment rate. The reason I did that is to try to let your eyeball see it as a peak. In September of 2021, the unemployment rate was around 5%, and then it got down to 3.5. That's why that's 96.5. 100 minus 3.5 is 96.5. That was sort of the peak. And then we've been coming off that peak. Right now, where we are now, the 95.9 employment rate, that's about 81st percentile historically, meaning better than about 80% of our history. At the peak up here, that unemployment rate was better than about 95% of our history. So when you say, I'm trying to help you visualize the fact that we hit a peak and now we're coming off the peak, or, you know, we hit a plateau and now it looks like we're coming off that plateau. And unless that blue line starts to creep back up again, if it keeps falling, other measures will mean other measures are falling too. And then you can possibly go back and say, all right, we had an economic peak here in early 2023. The NBER they're not going to probably, but they could theoretically say that's when we peaked. We have a little recession that has started. Nothing to panic about. The economy is, you know, again, this unemployment rate is better than 80% of our history, but it is not at the peak anymore. And so when you hear things like about the economy slowing, it's on this very high plateau. It's in great position, but it's slow. It's coming down off that peak a little bit. So keep your eyes on this. We may sneak this into the body of our presentation. I just wanted to give you a visual of a peak. All right, so that's it for our prepared comments.